Thanks, Mike. Hello. Brian with Bigfoot Capital. So we'll jump into talking. So the first thing you should know is Bigfoot's it's just a front company. It's not really, there's no substance behind it. It's really just a front company for a much larger, much more important company, which is a t-shirt company for cat pun lovers. So who loves cats within throwing range of this? Who loves puns? There you go. And I'm left-handed, so that worked out pretty well. So I've got to pimp that. It's a revenue-funded company. It's really my wife's company, gottolife.com. There's an Etsy link in the top left nav. Check it out. Another thing about me that you should know is I feel like I'm a first-time MicroConfer. I do feel like I'm the most committed MicroConfer I've ever met, as evidenced by my use of the slide deck template, which Rob didn't even use, so thank you, Xander. Number 3 is I went to bed at 8:30 last night. Anyone else go to bed early? It was awesome. It was so good. Which really to you means, 1, I'm energized to talk to you about capital, which is maybe not the most energizing subject to you. Hopefully it becomes more energizing. And 2 is, what was 2? 2 is you didn't have to see my networking face last night, which is basically me learning about your company, kind of going like that, but you'll see it tonight. So moving on. So why am I talking about capital at a conference for self-funded companies? Maybe not the most logical thing to do. Basic reason is that I've spent basically my whole career since 2004 really in and around other people's money. So I don't want to bore you here, but just like Jeff Bezos, I started my career in investment banking. Also, just like Jeff Bezos, I got out of investment banking to really start companies. So I was employee 1 at a company, founder CEO of another company, been an employee at 2 other companies kind of over the last 8 years. All software companies, all less than a few $1 million in revenue, all less than 25 employees, all of which had outside capital contributing to their success, hopefully. And so that's why I'm talking about capital. And that's why I started Bigfoot Capital really about 15 months ago to support companies like this where I've spent my time with a different form of capital because I kind of share Rob's anti-VC is the only way mentality. It's not the only way. It's a super prevalent narrative in types of companies such as yours. And so I think there's better ways to go about doing this. And my way of that's Bigfoot. So, that was supposed to be before. That's where we're going. So who are these people with this money? Basically, they come in all shapes and sizes, come into your company at different points in time. They got names like everything up here on this screen, but at the end of the day, they're people, and really people who have been entrusted by other people to make sound investment decisions. That's all they are at the end of the day. And so given that they put money out, the people they got it from expected to come back larger, they really need to make these good decisions. And so while they're all different in terms of how they do it, they're really all the same. And so the way they're the same is they all have a common fear, the same fear. Anyone care to guess what that is looking at this slide? It's not death. It's actually a more visceral fear felt by capital providers than the long-term fear of death. So that fear is really the fear of underperforming and the text effects that come along with that. So why would you be deathly afraid of underperforming as a capital provider? It's basically because if you put money out, it doesn't come back as expected, you're probably not going to get any more money, which means you're probably not going to be an investor anymore, which means you need to go to LinkedIn and find a job. And so none of that's good. So in order to ever put money out the door, what does that require to overcome this primal fear? And the answer is comfort, right? So at the end of the day, investors need comfort. It's more important than anything over the long term, more important than excitement. Of course, we want to be excited, stay excited, but we need to be comfortable that we're making good decisions here with other people's money. And so that's really what this talk is about. How do you give these investors comfort early on in the process so maybe they will invest into your company if you should choose to let them? So it really all starts day one. Basically, how you go about this process of raising money is an indicator for how you operate the rest of your business, which at the end of the day is an indicator for will that money come back and will more of that money come back? So the focus here is 6 pitfalls to avoid when raising your money. Let's jump into them. First one's casually raising. Raising money is not fun. No one likes it. I don't like it. And this leads to the notion of, yeah, I'm kind of raising money. Like, yeah, I'm doing it. You're not really doing it if that's your mindset, right? And so some symptoms of that are it's been forever and a day, right? Maybe we talked, you said, yeah, Brian, I'm raising money. Awesome, great. When you're looking to close that money, 60, 90 days, 120 days later, you still don't have any money. It's like, are you really raising money? What's going on here? So I start to question your commitment, which may not be fair, but I do. I have that bias. I put you in a bucket. I'm going to turn my attention to people who I feel are more committed and are showing that commitment. Number two is, if you're casual, you're not putting me to work. Like, I really can't do my job without hopefully helping you try to do your job, or at least a portion of it, right? So put me to work. I want to try to be helpful. Ask me about the process. Ask me about other players. Ask me for intros. Ask me to review your model. All of these things that I want to do, and I'm looking for you to hold me accountable in doing that. So don't let me underdeliver. Otherwise, I'll lose the inclination to help. And again, focus on people that are kind of pounding me to do these things for them. Number three is, I'm not the only one. Investor markets are often localized. They're small. Word gets around. Deals get stale. And again, people move on. So all those make it really hard to actually bring that money in and put you off on a bad first footing. So number two is having poor timing. This is pretty simple. You're either too early or you're too late. I've raised money twice for pre-product launch companies. It sucks. I'm never going to do it again. Starts the clock ticking. You can't explore. You can't iterate. You can't learn. At least I felt this way. And it's a very stressful position to be in. So I'd say first and foremost, and I don't think that really applies to anyone in this room, so kudos to you. But you can be too early, right? Not that you shouldn't maybe test the waters a little bit, have some conversations. But again, you just have to prove more faster. And I'll tell you with Bigfoot, just specifically, Bigfoot's looking to invest into SaaS companies that are, call it $500,000 in run rate, which is basically your last month's revenue times 12, up to $3 million. And this is SaaS revenue. And we're looking to put, $200,000 to $1 million into companies like that. And so, we'll have a conversation early, but just know that, like, from our perspective, that's our investment profile. And every investor out there has their investment profile. Another one's being too late, waiting too long. And this can happen easily, right? So maybe you've got a month of runway, you're burning some money, you can't grow out of it, and all of a sudden you appear to be a distressed investment situation. So I'm not saying you can't get a deal done, but if you do get a deal done, you're probably not gonna love it. So that's a really challenging position and another super stressful position to be in. Number three is going after the wrong audience. I just told you what we look for at Bigfoot. It's pretty scoped down. So one way this looks like is you have a never-ending target list. It's somewhat easy to go out there and get a lot of names of people with money and firms with money, but it takes some work to really diligence that down and target appropriately, right? So if you tell me you're going to raise money from a private equity firm that invests in manufacturing businesses or a venture capitalist that writes $20 million checks, I'm going to be like, no, you're not. Like, cross those off your list. And I'll just pick on a bank for a second, I guess. Bank financing gets thrown around. Oh, I'm going to go get bank financing, and oh, it's going to be great. And yes, you may get a credit card. Yes, you may get a small line of credit that's backed by your own personal assets. Yes, they'll always take your deposits. And we work pretty closely with banks. Like Silicon Valley Bank's a great partner of ours, but they're not going to write a check if you're not venture backed by like a Kleiner Perkins or a Sequoia, and they're not going to write a check if you want like 250K. They want to put $1 million out the door because they're inefficient banks and don't make any money off of smaller loans. And so that starts to question your qualification ability. Like at the end of the day, this is sales. So you got to target and work a process, work a pipeline, and go after the right folks. Number four is having unreal expectations, right? We all have unreal expectations. We think we're super valuable. Things are going to happen super quickly. Things are going to be good. I think we have these expectations. Maybe we don't. And then we go get beat down and don't accomplish those things. And maybe we reframe our expectations. And so being real with yourself is super important. So I know I just said target your list down, but don't have a tiny list. Don't have like 2 people, right? Have maybe 30 or something. I think the average like Series A, if we're talking VC speak, is probably the founder probably went after 30 to 50 funds and closed one. We're a little bit different. We know what we look at. We don't have the VC lens. So the conversion rate, for us is a little bit higher. You just need to have a big enough pipeline. Number 2 is a short window. These things take anywhere from a month to 12 months. Our process is about a month from our first conversation. M&A transactions I've worked on take 12 months. Like, they just take a long time. So if you don't appropriately frame that in your mind, you're gonna get tired. It's called deal fatigue. You're gonna lose steam. It's like missing estimates on delivering a product. It's like, it's like anything where you're just not achieving what you thought you were gonna achieve. And so the last one's overestimating your value, right? People get turned off if, they think, everyone asks me about price. I'm like, it's generally here's $100,000, you're gonna pay me back $150 over 3 years. And some people, just straight up balk. And it's like, look, there's some risk here, and we think our money's a value, and hopefully we can be a value otherwise. Same with equity valuations, right? Rob mentioned some, fund-strapped, like the term, equity valuations yesterday, which seem reasonable, right? If they were 2 to 3x that, they're not reasonable. And you really shut down your market opportunity. Overoptimizing, we've only got 2 more, so I'm trying to rush through these. Overoptimizing feels like death by 1,000 cuts from my perspective, right? So maybe we've signed a term sheet, we feel good about it, it's mutually agreeable, and then like renegotiating starts happening. That's super challenging. We're working on trust, we're still building trust. I've known you for maybe 20 days, right? And like, it just kind of makes you wonder, God, is this the way it's always gonna be? Good faith just kind of goes out the window. Overemphasizing edge cases. Look, any investor is gonna have agreements, pretty standardized, that they use. They want uniformity across their portfolio. And while they may you can move some things, you cannot move the vast majority of things. So, and they generally never come into play. They're gonna be protective measures, sure. So don't focus on that too much. Inability to get comfortable is another one. I'm gonna skip over this, but it causes doubts late in the game, which is the worst time to cause them. Last one's not thinking ahead, super important. So you do what's comfortable. The convertible note overdose is something I talk about. It's like, we got a note open. We're just gonna raise on that forever. And now we got 50 people that invested in our note. Now we got a messy cap table, and now no future investor wants to get involved with that situation. And by the way, we've sold like 50% of our company without knowing it. The second one is you lock yourself in. Because oftentimes you can take financing that makes it really hard. It's gonna beep at me. Didn't beep at me. Makes it really hard to take on future capital, and which really at the end of the day reduces your optionality, right? So you always wanna have optionality. You wanna make a decision, get resources, go heads down, come back up, see if that still makes sense, and you don't wanna be locked into something that no longer makes sense. So here's the recap. It's basically sales. If that's not your thing, please get help. Seek help with it. You still need to be intimately involved, but get some support. Have a process. It's just like any other part of your business. Building a product, selling stuff, running marketing. And investors are skeptical. So the whole point along this process is reducing our doubt and making us comfortable. Lastly, happy to talk about any of this. So I think that's it. Oh yeah, you can hit me on my Calendly link, email me. There's that big URL. Thank you so much.